Imagine you have just received a large sum of money. Perhaps it is a long-awaited inheritance from a loved one. Maybe you just sold a family home that you owned for decades. Or perhaps you have finally reached the end of a long and successful career. You finally have your retirement nest egg right in your hands. Your first instinct might be to put all that money into the market immediately. You want to start growing your wealth as fast as possible. But for someone over the age of 60, this single decision carries a hidden weight. One wrong move at this stage of life can change your future forever. Today, we are diving into a critical choice for every retiree. Should you invest everything at once, or should you move slowly? This is the classic debate between lump sum investing and dollar cost averaging. For younger investors, the math is often very simple and direct. But for you, the rules of the entire game have changed. In retirement, you no longer have 30 years to recover from a market crash. You are playing a game of protection, not just aggressive growth. The biggest threat to your financial security is not just a bad market year. It is something called the sequence of returns risk. This is the danger of a major market downturn happening right when you start. If you invest $1 million and the market drops 20% tomorrow, you are in trouble. You have lost $200,000 before you even began your retirement journey. This is why we must look at these strategies through a defensive and wise lens. Let us start with the case for lump sum investing. Mathematically speaking, the stock market tends to go up over time. Research from Vanguard shows that lump sum investing wins 68% of the time. This is because your money spends more total time working for you. If the market is in a steady climb, every day you wait is a day you lose profit. For a young professional with a long horizon, this math is almost undeniable. But you are not a young professional looking for a quick win. You are at a point in life where your primary priority is peace of mind. Even though lump sum investing wins most of the time, it loses 32% of the time. In those specific cases, the losses for a senior can be truly devastating. If you invest everything at the very peak of a bubble, it could take years to break even. At age 65 or 70, those are years of life you simply do not have to spare. Think about the psychological impact of seeing your savings disappear in weeks. Psychologists call this loss aversion. For human beings, the pain of losing money is twice as powerful as the joy of gaining it. When you are retired, that emotional pain can lead to very poor decisions. This is where dollar cost averaging becomes your greatest tactical shield. Dollar cost averaging means you divide your large sum into smaller, manageable parts. You might take your total amount and divide it into 12 equal payments. Then, you invest exactly one part every single month for a full year. This strategy completely changes your relationship with market volatility. If the stock market goes up, you are happy because your initial investments are growing. If the stock market goes down, you are also surprisingly happy. You are happy because your next monthly payment will buy more shares at a much lower price. You are effectively lowering your average cost per share over time. This is known in the financial world as averaging down. It acts as a powerful insurance policy against a sudden and sharp market crash. It removes the immense pressure of trying to time the market perfectly. Timing the market is a fool's errand, even for the most seasoned experts. For a retiree, the emotional benefit of this strategy is worth more than gold. Imagine the stress of watching your entire life savings drop in value overnight. That intense stress can lead to a dangerous behavior called panic selling. Panic selling is the #1 way that seniors lose their financial independence. Dollar cost averaging prevents that panic from ever taking root in your mind. It gives you a sense of absolute control and a clear plan to follow every month. Now, let us look at the specific economic landscape of 2025. We are living in a very unique and historic time for savers and investors. For the first time in many years, cash is actually earning a very decent return. High-yield savings accounts are currently offering 4 to 5% interest. This changes the math of dollar cost averaging heavily in your favor. While you are waiting to move your money into the market, your cash is not sitting idle. It is sitting in a safe, insured account, earning a steady and guaranteed return. This narrows the strategic gap between the two investment methods significantly. You are essentially getting paid by the bank to wait and be patient. In the current market, prices are hovering near all-time record highs. Interest rates are fluctuating, and global political tension is very high. This is exactly the kind of environment where defensive posture is extremely wise. But wait, there is another layer to consider for your 2025 strategy. It is the balance between your cash reserves and your equity growth. When you use dollar cost averaging, you are maintaining a healthy cash buffer. This buffer protects you from having to sell stocks when they are down. In professional circles, we call this maintaining liquidity. For a senior, liquidity is the ultimate form of freedom. It means you can pay for a medical emergency or a home repair without stress. You do not have to worry about what the Dow Jones is doing that specific day. So, how should you actually implement this plan in your own life? I recommend a very measured and disciplined approach for all my senior clients. Start by taking a deep breath and looking at your total investment amount. Set aside enough cash for your immediate living needs and an emergency fund. Then, take the remainder of the windfall and divide it into 10 equal portions. Automate your investments so that one portion moves into the market automatically. Set it for the first day of every month to remove all emotional decision-making. By doing this, you are committed to the plan regardless of what the news says. You are not checking the stock market every morning with a racing heart and sweaty palms. You are allowing a professional process to work for you while you enjoy your life. After 5 months have passed, you will have half of your money working in the market. If the market crashes during those 5 months, you will be incredibly glad you have cash. You will be able to buy into great companies at much lower and better prices. If the market keeps climbing higher, you are still participating in those gains. You are perfectly balancing the fear of loss with the fear of missing out. This is the exact definition of a sophisticated and mature retirement strategy. It is about surviving the worst-case scenario while hoping for the best. In retirement, your primary job is to make sure your money lasts as long as you do. You have worked hard for 40 years to build this wealth and this legacy. Do not let a single month of market turbulence take that hard work away from you. Choose the path that allows you to sleep soundly and deeply at night. Choose the path that protects your personal dignity and your long-term freedom. Mathematics and computers might prefer the quick lump sum approach, but human wisdom and experience almost always prefer a steady and careful hand. As we move further into the year 2025, keep your eyes on the long term. Focus on your overall asset allocation and your specific risk tolerance. And always remember, the best investment strategy is the one you can actually stick to. If the market dropped 20% tomorrow, how would you truly feel? Would you rather be fully invested and exposed? Or would you be happy to have cash? Having cash on the sidelines is not a sign of weakness. It is a sign of strategy. Please share your thoughts and your own personal experiences in the comments below. We all learn best when we share our financial stories as a growing community. If you found this guide helpful, please consider sharing it with a friend in your circle. Your financial health is your greatest asset in your golden years. Take care of your money, and your money will take care of you. This content is for informational and educational purposes only. It should not be considered professional financial or legal investment advice. Please consult with a qualified financial advisor before making any major moves. Every financial situation is unique and requires a personal and careful touch. Thank you for watching and for being part of this journey toward true financial peace.